And they're not realizing how what they believe is going to happen. People are hurting. People are losing their jobs. We can't cut government programs when people need them than it is right now. I mean, it certainly could move higher, and that could put more downward pressure on gold.
2025 is shaping up to be a make-or-break year for the global economy, and Peter Schiff is back with a wake-up call. Imagine a world where rate cuts vanish, inflation soars, and markets crash, all while the Fed scrambles for answers. Is this the future we're headed for? Let's dive into Peter's bold predictions, the hidden strategies behind the Fed's actions, and what it means for your wealth. Schiff leaves us with a stark warning. Either the stock market crashes or the dollar crashes. One of these disasters is unavoidable.
He said he wants to watch inflation carefully. See, this is another thing the markets didn't like. We're going to watch inflation carefully before we make our next move. And so what he's telling the market is if we keep getting these hot inflation numbers, if we don't get more progress, we're not going to make more cuts. So even though the Fed is signaling that we may have 2 cuts in 2025, we may not have any cuts. If the inflation numbers don't come down, those cuts are not going to happen. And if those cuts are not going to happen, the market's going down. Stock market's going down, bond market's going down, real estate market's going down. So stocks and bonds, regardless of what you own, they both went down. The markets are not cooperating with the Fed. Again, that's why I think the Fed's going back to QE. The only way they're going to get a meaningful reduction in long-term rates, at least short-term, a short-term reduction in the long-term rates, is if the Fed buys those bonds. And the only way the Fed's going to be able to buy those bonds is if they print the money to do it. And so they got to go back to QE. Now, it's not going to work long-term. I think that's going to blow up in their faces, but, they're going to do it anyway because they got nothing else. Again, he kept talking about how the economy is in a really good place. He said that a few times. We're in a really, really good place. We're in an awful place. We're between a rock and a hard place. We are nowhere near a good pace. He said, but rate cut path is slowing due to stronger growth and higher inflation. Again, he admitted that. Our path of rate cuts is slowing down now because the economy is stronger than we thought, which it's not. I don't even know where they're coming up with that. But inflation is higher than they thought. That is a true statement. And it's actually a lot higher than they thought, and it's going to get a lot higher. And that's when he talked about the natural rate being higher. And he talked about more uncertainty. He said there's a lot more uncertainty now, with inflation. So the Fed thinks that inflation is going to come back down, but they're not really certain, or they're less certain than they were before. And that also spooked the markets. Then again, I already mentioned this, but he acknowledged that it's going to take years for wages to catch up with prices. Problem is they're never going to catch up because prices are going to start rising a lot higher. Yeah, he said he's not going to settle. I already mentioned a lot of this stuff. I'm just looking at the notes that I made while I was listening to him talk. In fact, I was listening, getting ready to go on Fox Business with Liz Claman. So I was, listening and, doing other things. They would not settle for 2% inflation, and he would not rule out, not rule out rate hikes. So that's those are the notes that I made. So I kind of already covered most of that stuff along the way. But this was probably, in the scheme of things, the most hawkish press conference he's made. Right. And again, he's not really a hawk. It's just, less dovish. But this is not what the markets wanted to hear. Powell basically said, I'm not really sure what's going to happen. Inflation is higher than we thought. It's not coming down the way we thought. And so we're going to have to scale back these rate cuts, and we're going to have to wait and see. It was a close call. We were thinking about not cutting rates today. In fact, there was one dissent. There was one voice on the Fed and the FOMC. And there were some non-voting members, too, that expressed a disagreement with cutting. So there was some division at the Fed. Not everybody wanted to cut. And now they're not sure when the next cut is coming, if the next cut is coming. They can't even rule out a hike coming, which would be the appropriate policy because, they stopped hiking too soon. They never got restrictive. We need a lot more rate hikes. But again, the economy is too broke to handle them. The interest now on the debt, I think, is up to 1.3 trillion a year is what we're paying in interest. Remember, this is a moving target because every month more low yielding debt matures and it has to be rolled over at higher rates. And that is going to continue. You know, the yield curve is now normalizing. You've got a normal yield curve going out from a 1 year to a 30 year. The yield on a 12-month treasury is 4.26. 2 year is 4.34. 5 year is 4.39. A 10 year is 4.51. And a 30 year is 4.68. That's all positively sloped. The only negative slope is a 6 month, which is at 4.28, which is slightly above the 12 month. And the 3 month is still higher than the 12 month and higher than the 6 month. But I think that's going to change over the course of the next few weeks. I think you're going to get the 12 month potentially moving above the 6 month. In fact, that's going to happen. And then you're going to have a positive slope yield curve from 6 months down to 30 years. So you only have a little bit of a negative in the 3 month. And that may even flip. But what's going to really happen that's going to be a big negative for the market and the real estate market because of mortgage rates is going to be the steepening of that curve as we start to see the longer duration bonds moving up even more as a result of the loss of confidence in the government's ability to rein in the deficits. As people start to realize that what's happening with Elon Musk and Ramaswamy and all this is just a bunch of talk, right? Nothing is getting reduced. We're going to be in a recession. Nobody is going to be talking about cutting spending in a recession. It's like, there's no atheists in foxholes. There are no, hard money guys, monetarists, Austrians in a recession. They all want stimulus, even though the only stimulus that works is to cut government spending. See, the Keynesians don't get that. Government is the drain on the resources of the private sector. And if you really want to stimulate the economy, you got to shrink the government. It's like if, somebody is running in a race and they've got a backpack with 50 pounds of weights in the backpack and they're trying to run a race. How do you stimulate that guy? Do you put more weights into the backpack? No, you take some of the weight out so he has less excess weight that he's got to carry around. He can run faster and for longer if you remove some of the burden that he's carrying. And so that's the economy and government. Government are the weights in the backpack of the runner, right? Slowing the economy down, with burdening it with extra regulations and extra taxes. And yes, I think we'll get some deregulation out of Trump because that doesn't cost the government any revenue. But what's going to happen when the economy turns down? It's all going to be about stimulus. Nothing is going to get cut, right? And the politics won't let it happen. Who's going to vote to cut anything? Oh, when the economy is hurting, when people are hurting, people are losing their jobs. We can't cut government programs when people need them. We can't lay off government workers as if we were going to lay them off anyway. But how can you lay people off when unemployment is rising? So it's going to be bigger spending. It's going to be higher inflation. That is what's coming. And the markets are not handicapping that at all. The markets just think, oh, well, the economy in the U.S. is great, and the Fed's going to keep hiking rates, so the dollar's going to go up. And they're not realizing how what they believe is going to happen is impossible because we can't have the strong economy with rising interest rates when we have so much debt. And inflation is headed higher, not lower. And so we're not going to get this great economy that the Fed claims we have. We're going to have recession. And so there's a huge disconnect right now between economic reality and this economic fantasy. But it has caused this upward trajectory in the dollar. Again, I don't know how much higher the dollar is going to go than it is right now. I mean, it certainly could move higher, and that could put more downward pressure on gold. But, remember, in terms of foreign currencies, gold is holding up. And, it's not up $30 anymore. It's up $24, but it's still back above 2,600, 2,608. Look, I think gold is acting very, very strong. I read an article that the Chinese have been buying up a lot of gold recently. They're not talking about Bitcoin. They're buying real gold, and they've been buying a lot more than they've been letting on. I know there were some rumors, the Chinese don't want to buy gold now that Trump is there threatening them with tariffs. You know what? That means they want to buy even more gold. Whatever the U.S. doesn't want them to do, that's exactly what they're going to do. So take advantage of the weakness in gold.
Thank you for watching. Peter Schiff's insights remind us that preparation is key in times of uncertainty. Will the Fed's moves backfire, or will markets find a way to stabilize? Let us know your thoughts in the comments. And if you're ready to stay ahead in this economic storm, like this video, subscribe, and hit the bell icon for more deep dives into the financial world. Until next time, stay informed, stay prepared.